Investing with a plan gives purpose to your portfolio. Welcome to Retirement Mentorship, your mentor to and through retirement. I'm your host, Freeman Lundy, Certified Financial Planner. Today is part 3 in the Creating a Financial Plan series. Today we're looking at creating your investment plan. Investing funds many other aspects of the plan and is a critical step in your financial plan. And we will look at how to create an investing plan of your own. That's coming up on the Retirement Mentorship podcast. First, the 2-minute tune-in, primary points of the podcast in the first few minutes. Today, we're going to look at 4 things. First, why this investing plan is second in the overall creating your financial plan process. Investing is just one aspect of creating the plan, so why does it rank so highly in the order of things to do? This is because it runs in the background, so it can be done first and then run as you are doing other aspects of the plan, and because it determines many other aspects of the plan, which we'll dig into. Number 2, the purpose of investing. We'll look at why investing with a purpose is much more important than simply throwing money into different funds. Third, we'll look at the drivers of lifetime investor success. What is it that contributes to our lifetime investor success versus just our month-to-month or year-to-year success? And lastly, we will look at the 7 steps to creating your investing plan as a part of your overall financial plan. When we have an investing plan with a purpose, we are much more likely to achieve the goals that we have set for ourselves and our families. Investing is too important and the stakes are too high to wing it. You need an investing plan, and we are going to teach you how to get one. That's coming up on the Retirement Mentorship podcast. Creating a financial plan, part 2, the investing plan. You hear me say this at the end of every single episode in our pre-recorded disclaimer that this podcast is educational only and is not investment or legal or tax advice. I don't know if there have been too many episodes up till now that this applies to more. This episode is not investment advice. It's educational to help you think about how to do financial planning and how to create a financial plan. This is not financial planning for you. These recommendations are not for you specifically because I don't know you specifically. If you don't trust your ability to create your own financial plan, then work with an advisor that knows you and your specific situation to come up with recommendations for you. Again, this is not investment advice. But investments are very, very important to your overall financial plan, which leads us right into our first point of why investing is the second step of creating a financial plan. The reason I think is twofold. 1, investing runs in the background. There are a lot of other steps to the financial planning process and a lot of things that we will need to undertake, and investing runs in the background of all those things. Some of the items in financial planning require a lot of work and a lot of diligence and a lot of actual action. There are multiple steps that need to be taken on an ongoing basis to complete those portions of the financial plan. And they may take anywhere from a few weeks to a few years to check off certain portions of the financial plan. During those years, investing will be running in the background. Take, for example, the first part of the financial planning process, which is to control your cash flow. Again, we haven't come up with recommendations for this yet because we need to get through the rest of the financial planning process first to know what those cash flow recommendations are. Let's say we come back around and we determine that one of the best courses of action would be to pay down consumer debt. Perhaps you have credit card debt or other debt that is holding you back from achieving your other financial goals. And so part of the financial plan will be to take the first 6 months to 18 months to pay down a bunch of debt as fast as possible. In the meantime, you likely have a 401k or other investments that will be running in the background. They will be going up and down, but mostly up over time without your having to continuously interact with them. For that reason, creating an investing plan on the front end that can be running in the background while you achieve the other steps in the financial plan is critical to optimizing your overall plan. This is something that we can do straight away and then spend the hard work in the weeks and months working on the other pieces of the financial plan. The other reason creating an investing plan comes on the front end of the financial planning process is that your investing plan determines other aspects of the plan. For example, your retirement timeline will depend somewhat on what your investing plan is. If you are expecting a 4% rate of return, you may need to retire later than if you are expecting a 9% rate of return. So your retirement plan will be largely impacted and influenced by your investing plan. The same goes with your cash flow plan. If you have a mortgage that is 3.5% and your investing plan is expected to get a 4% rate of return because you are afraid of equities and want all your money in bonds and CDs and cash, then it probably makes more sense to pay off your mortgage than to invest heavily in fixed income. But if you're expecting a 10% on your investing plan, then perhaps you keep the 3.5% mortgage and put more into investments. So you start to see how many other aspects of the financial plan are dependent or at least heavily influenced by what our investing plan is. Because investing is done in the background and because so much of the other plan is dependent on what our investing plan is, we need to address it straight away here. We need to create an investing plan and plan to work the plan for many years and decades. Then we can look at the other areas of planning and come up with action steps for them. Now let's look at the why. What is the purpose of investing? We need to be quite clear on this because it will influence many other parts of the investing plan. The purpose of investing is funding your other life goals. The purpose of investing is not to beat some arbitrary benchmark. It is not to beat out your friends or have a better stock pick than them. It is not to beat the market. The purpose of investing is to fund your other life goals. Some life goals will be funded by working and earning money and cash flowing those goals. But many of them will be completely funded or at least largely augmented by investments. We don't invest for investing's sake. We invest for what it will get us in the end. For example, if we don't want to work until the day we die, then we are expecting to retire. To retire means we need a certain sum of money that will be able to kick back out our income that we need to live on in retirement. See episode 2. If we need that pile of money, we can either save it up in a bank, which would take a tremendously long amount of time, or we can invest to help fund that goal, both in building that pile of money and in the spending of it. And the purpose matters because it is going to define a lot of the other aspects of the plan. The timeline, the amount of volatility we're willing to withstand, any other risks we might undertake are all going to be influenced, if not dictated, by the purpose of investing. Often we will use different accounts to help separate the different purposes we have for investing. We'll use retirement accounts for the purpose of saving for retirement, and other non-retirement accounts for other goals. If we have not clearly defined the purpose of investing, then everything else is moot. So part of creating an investing plan is to clearly determine what we are investing for. It is the why behind everything else we do. For the rest of this episode, we're going to use the purpose of retirement savings because it is a big one and because most people have that as at least some type of goal. But a lot of these investing planning techniques will be used for funding any other types of goals that we are planning to use investments for. Lastly, before we go through the steps of creating an investing plan, we need to look at the drivers of lifetime investor success. Anytime we're creating a plan, we are hoping that it is successful, that we achieve the goal. And if we want to be successful with investing, then we need to know the drivers of lifetime investor success. Note 3 things about this statement, drivers of lifetime investor success. 1, success is going to be defined by the purpose, which goes back to the purpose of investing. If we are defining success as beating a benchmark, but in reality it should have been having enough money to retire, it will not matter if we beat the benchmark for a while if in the end we ran out of money in retirement. Investor success means we achieved our goals. We achieved the purpose. Secondly, investor success. Does not matter what the investments do, only what the investor does. We covered this in episode 1, which if you have joined us since episode 1, you should go back and listen to it. It's foundational for everything else we talk about in this podcast. There's a big difference between what investments do over time and what the investor does over time. Doesn't matter what returns the investments have done over time. It only matters what returns you have gotten over time. And lastly, lifetime investor success. You can beat the market in 1 year or another, or achieve certain short-term goals, but what we are talking about here is your lifetime goals, your lifetime success. Again, if you save some fees for a few years, or beat the market for a few other years, or any of the short-term metrics, but you fail in your lifetime goal to achieve your lifetime plan, then it is not a success. We're looking at the drivers of lifetime investor success here. First, there's one that trumps all others, and then there are 5 more. So the number one driver of lifetime investor success is the investor's behavior. We covered this in episode 1, investor returns versus investment returns. Upwards of 90% of your lifetime investor success is dependent on your behavior, on killing and keeping killed the 4 horsemen, which we covered in episode 4. Nothing else matters if your behavior is bad. You can do everything else right, have picked the best funds, have lucked out in many other areas, and if your behavior fails you, so will your plan. The average investor's return is half of the return of the investments the investor invests in. Over 30 plus years, that means they're ending up with a fourth or less of what their investments would have gotten if they had simply followed a plan and stayed the course. Meaning that if you create an investing plan and stick to it, you are likely to beat out by 2, 3, 4, 5 times the average investor and be better off than 90+% of your peers. Behavior is so important that, again, if you have not listened to episode 1 and have not really felt the impact of this, you need to go back and listen to episode 1, episode 4, episode 2, and episode 7. This is foundational. Behavior trumps everything else. It is the number one driver of lifetime investor success. Beyond behavior are a few other items. And for the sake of argument, let's assume that your behavior is spot on, that you're not making any of the behavioral mistakes over the decades of your investing career, and that everything else is held constant. Now let's look at what are the other drivers of lifetime investor success. Number 1 is asset allocation. This drives up to 75% of your lifetime returns. Again, assuming that behavior is held constant. 75% of your lifetime investor success will be dependent on the percentage of equities that you hold in your investment portfolio as compared to the percentage of fixed income. Now, equities are stocks or stock mutual funds, stock ETFs, and stocks and equities are the same thing. I prefer equities because many of us are familiar with buying a house and having equity in our house, which is the percentage of the house we own compared to the percentage of the house that the bank owns. And when you own equities, when you own stocks, you have a percentage ownership in those companies. You are a business owner. You have equity in the single stocks you buy, and you have equity in all of the companies that are inside the mutual funds or ETFs that you buy. Now, stock means the same thing, but again, I think we're more used to hearing equity as ownership when it comes to home equity, and so I prefer equities to stocks when we're talking about investing. Now, a lot of people get asset allocation and diversification mixed up. We hear diversification and we think of that as the mix of equities and fixed income that you should have. Fixed income is all of the other types of investments that have a fixed interest rate on them. Think bonds and CDs and cash and treasury bills. All those types of instruments collectively are called fixed income. And a lot of times when we think of diversification, or sometimes it's even the way that it's explained, is that we need to be diversified across lots of equities and fixed income. That is incorrect, at least for our purposes. Asset allocation is a percentage that you have between equities and fixed income. Diversification is the percentage that you have inside of those. So you could be diversified inside of your equities by owning lots of different types of equities and lots of different funds. You can be diversified inside your fixed income by owning lots of different bonds and lots of different fixed income types. Asset allocation is an either or, fixed income or equities, and diversification is the range inside of either of those asset classes. There are other types of asset classes, of course, such as real estate or commodities or futures or some of these other types, but we're not going to get into those in this episode. After behavior, the number one driver of investor lifetime success is your asset allocation, the percentage that you have in equities compared to the percentage you have in fixed income. 75% of your total return will be dictated by the amount you have in equity. The more of your portfolio that's in equities, the greater your return will be. It's that simple. Nothing else you do will make up for not having enough in equities. You can pay no fees. You can have great bond picks. You can pay no taxes. And you can have a very, very diversified mix of fixed income. And none of that will matter compared to someone who has much more equities than you do. Over long periods of time, which usually defines lifetime, equities outperform fixed income by a lot. And that compounds over time to make up a lot more. So the percentage that you have in equities is the number one determinant of your lifetime investor success, assuming you hold behavior constant. Asset allocation, 75%. The next driver of lifetime investor success is your diversification and rebalancing. This makes up possibly another 10% of your lifetime investor success. As we just briefly talked about, diversification is your mix inside of those asset classes. So perhaps you have 100% in equities, but it is all in Apple stock. Well, that's not very diversified, and if something happens to Apple, you are absolutely screwed. So you will want good diversification inside of your asset classes, not all your eggs in one basket. The principle here, of course, is to never own enough of anything to make a killing on it, but also to never own enough of anything to be killed by it. We covered this in episode 4, the 4 horsemen, where one of the horsemen is poor diversification, either under diversification or over diversification. And we talked a bit about it there. You'll want a good amount of diversification, spread it out over lots of different types of equities or fixed income, but not too much in that it creates a plan that you don't understand and cannot follow, or that may be producing more redundancies and higher fees. So you want the right amount of diversification. Rebalancing is bringing your portfolio back into alignment. So perhaps you have certain percentages of different types of equities. They will grow at different speeds and fluctuate at different rhythms. And so occasionally you will need to rebalance those and bring those back to the original plan. And so your diversification and your rebalancing plan will make up another 10% of your lifetime investor success. Diversification and rebalancing, 10%. We're at 85% total with just those two. Taxation will bring about another 10% of your lifetime investor success. We all pay taxes, and to a certain extent you cannot change that, but there is lots of planning you can do to minimize your taxes, and those could have huge impacts in your lifetime investor success. We'll cover that, of course, in depth in our tax planning episode. So I'm not going to say much more about it here other than that it will make up about 10% of your lifetime investor success. If you're doing the math, we're already at 95% with just 3 items. Number 4 is fees. Fees do have a large impact on your investment returns, but much less on your investor returns. All other things being equal, of course, we should pick investments with lower fees. There's no point in paying for things that we're not getting any value on. But some people overblow the impact of fees on their lifetime success and always opt for the lowest fees possible. They're highly fee averse and, if possible, would never pay anyone anything. This causes them to lose out on lots of potential tax planning opportunities, on different retirement and equity-based planning strategies, and many other things that contribute to your lifetime investor success. So fees are important. They do make up 4% of your lifetime investor success, so we'll want to minimize those, but they are not as important as many people make them out to be. Fees are 4% of your lifetime investor success. We're at 99%. The remaining 1% of your lifetime investor success will be made up by your selection, which is the actual funds that you choose inside of your diversification and asset allocation plan, the timing of when you buy and sell those funds, the hot stocks that you end up picking up, and everything else that you could possibly imagine when it comes to investing. All the tactics and tricks and tips and all those things that you so often hear about when you're reading about investing or reading blogs or news articles or any of that make up possibly 1% of your lifetime investor success. If I were you, I would spend all your time and energy focused on the 99% of things that will drive your success and forsake the 1%. Especially when, by accident, you may do just as well at that last 1% as anyone else. So there they are, the drivers of lifetime investor success. Behavior is number 1, overall, completely usurping everything else. If we don't have that, we don't have anything. If we hold that constant, then asset allocation makes up 75% of our lifetime investor success. Diversification and rebalancing is another 10%. Taxation is 10%. Fees are 4%. Everything else, 1%. We're covering investing second because it runs in the background and because your investing plan determines many other aspects of your financial plan. The purpose of investing is to fund other life goals that you don't want to fund with cash flow. It's not about beating a benchmark or beating your peers. It is about funding your goals. And we just examined the drivers of your lifetime investor success. How do we add all these together to create an investing plan for your overall financial plan? We create an investing plan in 7 steps. Here they are. Number 1, we adopt a planning mindset. We adopt a planning mindset. If we want a successful investing plan, first we must have perfect behavior. Bad behavior will ruin everything else that we do. Again, your investor behavior is the far and away largest determinant of your success. And behavior comes from belief. So we must, in adopting this planning mindset, first gain the knowledge that we need. We don't need to become experts on individual investments. We only need to know enough to create and follow an investing plan. We need to gain that knowledge. Then we need to build and bolster belief. We need to build up our belief in planning, that creating a plan and following a plan is the only way to lifetime investor success. If we get distracted from the plan, chase fads and fears, we will never be successful. We need to build up our belief in financial planning, in investment planning, in following the plan, and we need to continue to bolster that belief. That belief will be challenged, it will wax and wane, it will be bombarded by other opinions and other so-called plans. And we must bolster our belief to negate those attacks. We need to kill the 4 horsemen that will attack our plan and stick to the plan. We need to adopt a planning mindset. That is, we believe in planning and we believe in sticking with the plan no matter what. Step number 1 is adopt a planning mindset and everything that comes with it. That is what this podcast is all about. Is helping you gain the knowledge you need and to build and bolster your belief in planning. Number 2 is identify the purpose. What are we investing for? retirement, paying off a house, we need to know two things about our purpose. The amount, how much, this is a dollar specific number, what exactly do we need to get to achieve this goal, and a timeline, the when, date specific. So we need a dollar specific, date specific purpose for our investing. For example, we need $70,000 by the time Curly is 18 years old so that we can pay for college in cash. We need $2.2 million by the time we reach age 60 so that we can retire. Date specific, dollar specific, identify the purpose of your investing. Third, we need to determine the asset allocation and schedule. Determine the asset allocation and schedule. Again, another disclaimer, this is not investment advice. This is education. Get a plan for yourself and give yourself the advice or find someone who can give you advice. But if you were to ask me, then I would say, if you were a planning client of mine and we'd gone through everything else that we needed to talk about, that if you were more than 10 years out from your goal, let's take retirement as an example, then you could be 100% equities. That would be your asset allocation. 100% equities, 0% fixed income, up to 10 years out from your goal. That's your asset allocation. Now we need to find the schedule, because as you approach your goal, you will eventually need to start paring that back to subtract some from your equity allocation and add more to your fixed income. I believe that process starts at about 10 years out and begins to transition to more fixed income. If it's a retirement goal we're talking about, then ideally you would finish at around 80% equities and 20% fixed income. Now this is way, way more equities than the conventional knowledge would tell you to do. Most target date funds, for example, would get you down to 50-50 and even 40% equities and 60% fixed income. And here I'm saying 80% equities and 20% fixed income. Now again, there's going to be more about this in retirement planning, but that's the general idea. After you have determined your purpose, you will want to create your asset allocation and then a schedule for when that asset allocation should change. If what I just laid out for asset allocation and schedule surprises you for retirement planning, then make sure you stick around for the retirement planning episode coming up in a few weeks. Number 3, again, is to determine your asset allocation and schedule. Step 4, then, is to determine your diversification mix. How are we going to diversify inside of that? We don't want all of our eggs in one basket, and there should be a little bit of strategy to this. We could, of course, dump all of our equities in the S&P 500 or in a Vanguard total market fund. We could put all of our fixed income in a total bond fund and call it a day. We could try to skip any fees that come with hiring an advisor or creating a plan with someone else, and we could just obey the rhetoric that fees mean everything and we should just throw it in an index fund and do nothing else. We could do that. Or with a little bit of research and a good plan, we could do better. You want to determine your diversification mix. What are you spreading it out by? Maybe you're switching it up by market cap, how big the companies are in the different funds that you're investing in. Maybe by sector, maybe by growth versus value, or maybe some combination of all. The important thing, again, is to not be over-diversified or under-diversified. I often see portfolios that seem like they have very good diversification, but if you look under the hood of many of the funds inside of their portfolio, they contain a lot of the same companies, and they're not nearly as diversified as they think. When I'm creating a diversification mix, I make sure to spread it across multiple different types of funds, and that none of those funds contain the same companies. It's important to be actually diversified at the company level, and to do that means picking good funds at the fund level. I care less about the funds themselves, aka the brand name behind the fund, and more about the types of equities inside of them, whether it be small or large or growth or different sectors or whatever it may be. So you want to determine your diversification mix and then stick with the strategy that you have come up with. The first horseman is chasing returns. It is not sticking with your diversification mix. It is not sticking with your asset allocation mix. It is changing them up in the middle of the worst possible times. Whatever you pick for these two, your asset allocation and your diversification mix, you must stick with it. That's why it is important to have it be based on a long-term plan and not just choosing funds willy-nilly. Step number 5 is to determine your rebalancing strategy and schedule. Rebalancing, as we talked about, is bringing pieces back into alignment. And this is a critical step because if you do this, you can result in greater lifetime returns than you otherwise would have. Let's take a short example here. Let's say that you have some funds that are invested in small companies, in medium companies, and large companies. 3 different funds. And let's say that you throw $1,000 into each of these 3 funds, small, medium, and large. Each of these funds, over a long period of time, have averaged 10%. And so you are confident investing in all 3. You throw $1,000 into each and you wait a year and you come back and you look at it. And we see that the small fund has gone up 40%. It's up 40% and you've gone from $1,000 to $1,400. The medium fund has gone down 20%. You have lost $200 and you are now at $800 in the medium fund. And the large fund has gained 10%, has gained $100, and you have $1,100 in that fund. As you look at them and evaluate, you think to yourself, the small fund has done awesome. This is a keeper. I absolutely must have money in that fund. But this medium fund, man, I lost money. Everything else went up, and I lost money in the medium fund. This fund is garbage. In the large fund, 10% is okay. I guess it's average. It's doing its job. It's not amazing, but maybe we'll stick onto that one. And the average investor would then proceed to dump the medium fund after losing 20% and to realize that loss and probably put a lot of that money into the small fund, which has been shooting out the lights. That is the very human thing to do, but it'd be the very wrong thing to do. Again, if all these funds have averaged 10% over time, they will revert to the mean. They will come back to their averages, which means that if the small fund just did 40%, what is it going to have to do at some point in the future to come back to its 10% average? It's going to have to go down. And not just down below 10%, it's going to have to go way down because it needs to average out this high that it had last year of 40%. In the same way, if the medium fund normally does 10% and just went down 20%, it's going to need to come back way up past its average in order to average back out to 10. And so what rebalancing does is it systematically sells high and buys low. So in this example, what we would do is we would rebalance all the funds back to an even number. So we would take the $1,400 in the small fund, we would carve out $300 of that, and we would just stick it in the medium fund. And that would bring all 3 back to $1,100. We balance them, we rebalance them back out to being equal. What we've just done then is we have sold off $300 of the small fund at the top, and we have invested $300 into a bottom of a cycle in the medium. We are selling high and buying low systematically. It's the opposite of what humans do by instinct, but if we do this consistently and systematically over time, we will mathematically and systematically be selling high and buying low and beat out the average of those funds on their own. And so having a rebalancing strategy, when and how often we're going to rebalance, is number 5 in the steps to creating an investing plan. Want to establish that strategy and to stick with it. We don't want to rebalance anytime things are moving around. We want to find a specific time and rebalance. Usually it's annually. Once a year, we rebalance all of our accounts and then we don't look at it again until the next year. It's tough, it takes discipline and patience to do that, but it is the way to success. Number 6 is to minimize taxes and fees. We minimize taxes with tax planning, which again we'll get to in a future episode, and we minimize fees by paying fees only at the level of value. All other things being held constant, we want to pay less fees. If I'm investing in an S&P 500 fund, and all S&P 500 funds are basically the same, then I want to pay the least possible fees because I'm not getting anything out of paying more fees for the same type of investment. But there are definitely some things worth paying fees for. So just make sure that in minimizing your fees that you are paying fees for value and that you are avoiding fees that don't give you anything extra. And the last step in the plan then is to execute the plan and evaluate. Execute and evaluate. We need to take everything we just came up with in steps 1 through 6 and actually do it. Knowledge and belief are not enough. We must act. We must create the plan and we must execute the plan. And then we periodically evaluate the plan. Now here's an important piece of this. We evaluate step number 2, identifying the purpose. We evaluate to see if our purposes have changed. Has our goals changed? Did we originally want to pay for our kids' college, but then they decided they don't want to go to college, and now our goals have changed? Do we originally want to retire early, but then found a career we loved and realized maybe we would like to spend more of our money now and don't mind retiring later? Or perhaps the opposite is true. We continue to evaluate our goals, our purposes, to see if those have changed, and if they have, then maybe we change the rest of the plan. But if our goals have not changed, if our purpose has not changed, then the rest of the plan likely should not change either. You can still evaluate it, but the main piece that we are evaluating is step 2, your goals and purpose. So step number 7, execute and evaluate. Those are the steps in creating an investing plan. 1, adopt a planning mindset. 2, identify the purpose or goal. 3, determine asset allocation and schedule. 4, determine diversification mix. 5, determine your rebalancing strategy and schedule. 6, minimize taxes and fees. And 7, execute and evaluate. Creating an investing plan is critical to your lifetime success. And the sooner you do it, the more success you will have. If all of this seems like too much work, or perhaps you don't feel like you want the weight of all these decisions resting solely on your shoulders, then find help immediately. Get an advisor, a planner that can help you create and execute your investing plan. It can run in the background while you do other steps of the financial planning process, but it needs to be done. We are talking about the differences of tens and perhaps hundreds of thousands of dollars down the road by executing this now versus delaying even a year or two. It's the power of compounding interest. And so if you don't have the time or capacity or the competence or even just the desire to create an investing plan, then please get someone right away to help you do this while you're working through the planning process. We, of course, are available. Otherwise, towards the end of the series, we will teach you how to find a planner who's right for you. If you'd like our help, feel free to email any questions to questions@retirementorship.com. If you'd like us to look at your investing plan and to make any suggestions, we're happy to do that. If you have set up Right Capital from the action step on Friday, then the actions for later this week will be easy. If not, go back and listen to Friday's action episode and get Right Capital or some similar software set up so that you can evaluate better your current investing plan and create the investing plan that you need. That's all for today's episode. We look forward to seeing you on Friday with the actions that you can take from this episode, when we will see you then. This podcast is educational only and is not intended to be investment, legal, or tax advice or recommendations, whether direct or incidental. Again, this is not investment advice. Consult your financial, tax, and legal professionals for specific advice related to your specific situation. Never take investment advice from someone who doesn't know you and your specific situation. All opinions expressed in this podcast are the opinions of the speakers expressing them. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. Retire Mentorship is not affiliated with or controlled by any registered investment advisor, broker-dealer, or other financial services company.